Why pay more for your precious metals from the big guys with offices on Wall Street and who bank with JP Morgan? Get your fizz from the doc at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Joining us today is a special guest from miningstocks.com, one of the best gold, energy, and tech stocks and newsletters published weekly. We have Jay Taylor. Great to have you today, Jay.
Oh, my pleasure.
With the markets this week, we had the Fed minutes coming out on Wednesday, and is not too much surprise to any of us here or any of our listeners familiar with the cartel actions over the last 5 to 10 years. Gold particularly was taken down after the Fed minutes were released and traded the second half of the week back under the critical 1,300 level. Somewhat surprisingly, silver held resilient and it really refused to break down very much. I think early Thursday night, overnight Wednesday into Thursday, it did trade down towards 1920, but recovered off of that and traded the last 48 hours of the week with really a pretty tight consolidation zone between like 1935 and 1950. So we'll start with you, Jay. What do you take of the markets here this week in the wake of the latest Fed minutes?
You know, I pay very little attention to the Fed minutes these days because I think it's all very, very predictable. I don't think that the Fed has much of a choice but to continue, no matter what it says, with its easing policies. And so I just don't see any kind of serious winding down of the quantitative easing, no matter what they say. And even if the numbers suggest that they are tapering, I think there's a great deal of reason to doubt that they really are tapering. The huge amount of treasury buying that came in from Belgium suggests that there may be just a recycling of dollars created out of nothing. We had the United States, the Federal Reserve had provided a couple of $1 trillion worth of swap lines during the 2008, 2009, and thereafter problems that erupted around the world in the global financial system. And so I think it's just one big, one big group of central bankers that are basically trying to keep the global system from imploding. And imploding it would if they didn't continue to print more money. Because what has happened here for the longest period of time is that the total debt, not just the United States, but I would suggest even more so in some other countries, the total debt is growing much, much more rapidly than income is growing. So what I think you have is a global insolvency system that is being addressed by the Fed and other central banks with additional liquidity. But liquidity isn't the same thing. You can continue to print more money, but the problem with doing so is that each dollar has behind it debt. And so the more money you print, the more debt you create. But the global economy is so misallocated. Capitalism is being destroyed through the capital markets that capital is no longer being employed productively. Malinvestment, as the Austrians call it. So what you have is an inability to service debt. And so you're in I think all the central banks are on a treadmill in which they have to produce more and more, faster and faster to try to keep the global system from imploding. The markets move on these things, so I guess if you're a trader on a short-term basis, you've got to pay attention to the manipulation by words that the Fed uses to try to jerk you one way and then the other or keep you off balance or whatever they're trying to do. But frankly, you know, I just think you have to look at it from a longer-term perspective. And, you know, what I see is not very promising globally in the economy, largely because I think, as David Stockman has pointed out, we're in the process of destroying capitalism by financial repression.
Yeah, that's a great observation, and all three of us are informed by Austrian economics in terms of our perspectives, and I think that, unfortunately, the vast majority of people on Wall Street, you know, if you mention the word or the phrase Austrian economics, they kind of scratch their head and go, huh? You know, and every time we go through these periods where we have the Jackson Hole media parade or, you know, even just FOMC minutes releases, precious metals typically come under assault, and now the popular perception is, oh, the Fed is going to tighten a little bit quicker than previous expectations and whatnot. But backing up with what Jay said, and to remind our listeners, it wasn't until Bloomberg News sued the Federal Reserve that it was disclosed that trillion dollars, forgetting all my zeros, were used to backstop the crisis during the 2009 through 2010 period, and the subsequent estimates about the swap lines were as much as $30 trillion, where Federal Reserve would, for example, print up a lot of credit, and then the ECB in exchange would do the same. They'd swap it and then float their financial systems without direct impacts to the FX currency rates, crossed rates, because of the fact that the dilution was relatively neutralized because of both the main central banks of the world printing that kind of money, so to speak. So I mean, it's just a grand kind of charade that they're pulling, and we see this public relations junket unfold during these weeks where we have Jackson Hole festivities going on. I mean, I published an epic editorial rant today to that very effect, and we'll include a link to that in our write-up section for today's show. But as a segue related to that kind of stuff, Jay, I'm really curious because you talk to a lot of people in the media and a lot of portfolio managers, and you interact, and I'm just kind of curious, have you seen any kind of uptick in 2008 when it comes to intelligent questions coming from media professionals asking about manipulation in gold, or has it still been, as it has been for the pattern for this entire bull market, that people just see nothing and hear nothing when it comes to gold manipulation in the media?
Yeah, I think for the most part, it's a non-topic. I mean, it's just not something. Gold is, first of all, not a respectable topic in the minds of most mainstream Wall Streeters. I mean, it's a barbaric relic after all. It's something that stupid people who don't have PhDs from Princeton, Harvard, and Yale believe in. It is as James Grant says. We now know that that a few of the brightest folks from those prestigious universities with PhDs have a better standard. They are more wise than the markets, so we've gone to a PhD standard instead of a gold standard. So I think, for the most part, it's just put out of the minds of people, and I really think this is why this heavy-handed selling that takes place in the paper markets, where there's something like 100 times more volume in paper than actually gets settled out in bullion in the London markets and the New York markets, why these savage hits that take place in very thin markets are very important, because what I think it does is it serves to keep people's minds off of trading worthless paper currency for the real thing, gold. I mean, can you imagine, and I've lived through it long enough, 1979, 1980, when there was a massive stampede for gold. I mean, we haven't seen anything like that. We've seen gold rise from the low 200s to 1900, but we haven't seen anything like that mania. I can remember at Deke Pereira in New York, the lines going around the block, people waiting to buy gold, average people who didn't have any sense of Austrian economics or the importance of gold. They just knew that gold was rising like mad, and they could keep ahead of inflation by going out and trading those paper dollars, which were buying less and less, for gold. And so how the market, I mean, part of the con artistry of the Fed and the mainstream media is to keep people disinterested in buying gold. So if you see these smackdowns, you see, some geopolitical event that should cause anxiety to rise. You see some financial report that should really cause people to be concerned about keeping their money in banks or whatever. And then what you see is a horrendous smackdown of the gold price, and people say, why would I want to buy gold? It's not doing anything. And then you have the New York Times, the London Times, whatever, coming out and saying, see, gold just doesn't do what it used to do. Gold is no longer a safe haven. Well, they have managed to get most of the Western world, the people that have been, quote-unquote, educated, to believe that line of malarkey. But there's still a good part of the world that isn't quite so sure they believe their mainstream media and they believe their governments. And those places like China and Russia and elsewhere, people are lining up to buy gold still. So I think the big question coming down the pike is, it's geopolitical as much as anything. I think there's going to be things taking place in the near future where geopolitical forces may actually disrupt this con artistry game that's going on the part of our mainstream media, the Federal Reserve, and the government, and all the mainstream media.
Yeah, and in particular, the slow but sure, steady march away from the dollar reserve status that's being championed by Russia and China in particular, but BRICS and, in fact, the whole G20 for the most part.
Right.
Plays directly into that, and it's definitely accelerating. A year 2000 or so, the Chinese economy was but a fraction of its size now, and now, depending on how one measures, it's on par with the United States, or just slightly below it in terms of size and purchase power parity method. And over 25% of the world's trade is settled in currencies other than the U.S. dollar.
Uh-huh.
That's entirely new. So,
yeah.
Yeah.
Yeah, no question. And I think that what's going on with the United States heavy hand, a geopolitical heavy hand in forcing sanctions on Russia and so forth, is actually pushing that process faster, where the BRIC countries, and certain members at least, are finding more of a need to accelerate the alternative to the Anglo-American financial system that is really still the spoils of World War II, where we've kept our hands on basically on everything that goes on through the IMF and the World Bank and etc.
Jay, I wanted to shift gears a little bit here to talk about the mining shares. You've analyzed the mining stocks for quite a while, and this year in 2014, both gold and silver shares are really sharply higher almost across the board, and while gold and silver seem to continue their consolidation, that's often an indicator of stronger prices to come. And you did have Rick Rule on your show this week, who informed you that he thinks we're entering the greatest bull market period for resource shares in his entire career. And he's been around for a while. So how do you see the mining shares going forward? What is your thought on the diversification potential of mining shares versus all bullion? Do you encourage investors to diversify a bit with the mining shares versus strictly bullion? So what's your takes on that, as well as where you see the shares going?
Yeah, I do. I do think it's wise to have some shares in a portfolio. That said, I think that everybody should start out, though, with a bullion base. It should be gold and silver as the base. And then, depending on their risk profile, go out and buy shares. And I would say even more risk-averse people should probably buy a good fund. I like the Tocqueville fund personally. We've done very well with it. I know the management, Doug Groh and John Hathaway. I know them personally, and they've done a formidable job. I think over the last couple of decades, they've done very, very well. But then, if people who are more adventuresome and can spend some time researching and thinking about stocks, I think there's going to be some huge profits made in the junior sector right now. I mean, it is a risky business. I think mining is one of the riskiest businesses there is, because it's capital intensive. There's so much beyond your control, such as the metals prices itself. You have geopolitical, you have political issues, environmental issues. There's just a lot of risks in that business. And however, when things turn around, because it is so risky and so cyclical, when times get good, they get very, very good. I mean, I started in the late 70s and watched more from the sidelines because I was a young person, didn't have too much money then, but bought a few of the junior mining companies up in Vancouver, and saw one stock go from 3 to 17 in a very short period of time. Caroline Mines went from $3 to $60, and I think had one profitable quarter. But now, at this time, we've had now since 2002, a lot of capital has gone into this sector, and it takes a long time to establish viable projects. And I'm looking now at an index of the S&P TSX Junior Gold Stock Index, and it was at 460, 470 there, about 450 or so. The index was at 450 or so back in 2011 after it after it came back after the Lehman Brothers decline and the equity market decline. But it's still at around 200, so it's about half of where it was. And now, in the meantime, a lot of these companies have, since that high in the index, a lot of these companies have made great progress and have moved their projects towards production. There are a lot of companies, on the other hand, that are going to be gobbled up by the stronger brothers, who managed to survive and be cash rich and keep their projects moving forward. So I think there's going to be a lot of accumulation. The biggest risk that people face, I think, in this business is one of dilution. So investors should be very cautious about how companies spend the money. I like to see companies that have strong management, but management that has some skin in the game and that are really not interested in dilution. They're not interested in their salaries as much as they are in making money longer term in the stock. And there's a lot of them out there like that. I mean, I think there's a lot of companies that I'm very excited about now. So yeah, I think Rick Rule is right, and he and I are about the same age. We both went through the 70s bull market and then the decline. And I know that Rick is comparing this decline that we've had now with the one that took gold from about 200 to 100 back in the 70s, and then from 100 it went to 850. And I think we could see something like that, or something even greater than that on the upside percentage-wise in the next leg, and I think that will be the final leg up in the bull market in gold. I think we're going to have one major leg up in the bull market, could last 4 or 5 years probably. And so I think there's going to be an awful lot of money to be made in the junior sector. But that said, of course, it's also very risky. So people should balance their risk. Depending on their risk profile, their ability, their age, and all those factors, personal issues, they have to take into effect. Will your wife leave you if you lose a bunch of money, or maybe you want her to? And so I don't know. But that's another issue. But the point is that I think there's going to be a lot of money to be made. I think Rick is right. And you know what? I take a lot of comfort when Rick Rule tells me that, because I don't know how many gold shows I've been to where I've been a speaker and I'm sitting on the stage and Rick is on a panel, or he's leading a panel discussion, and he's telling people how he thinks things are getting frothy. And I'm saying, no, don't let the party end now, Rick. Don't let the party end. We're all having so much fun and we're making a lot of money. But he's usually right. He has a very, very good sense of the markets. And none other than Doug Casey told me once, I had them both on my show together, and Doug says that he says that Rick is the greatest investment manager he's ever met. So I think that's pretty good. And so, yeah, I think Rick is right. I think we're ready for a bull market of a lifetime in the gold shares now.
And your newsletter is one of the better ones when it comes to digging into the fundamentals of junior mining stocks. So if our people in our listening audience would like to check it out, we'll put in a link to the write-up as well, so that they can take a look at your newsletter. So I'm kind of curious, and this is also somewhat shifting tracks as well too. You follow pretty closely indicators of inflation and deflation. And over the last couple of shows, we've been talking with people like David Morgan and Kurt Ferguson about what looks like little signals coming through the financial markets when it comes to the pricing in among some traders taking big bets against the possibility of a credit crisis lurking under the surface.
Yes.
When you look at oil right now in particular, it's probably the most clean-cut indicator that speaks to this. You have the Middle East pretty much on fire, and the Islamic State in Iraq and the ISIS people talking about taking over Saudi Arabia. I mean, it's a kind of backdrop where you'd assume that there'd be a geopolitical risk being put into the price of oil, but we are not seeing that. And oil yesterday sliced all the way down to 93 and change for West Texas Intermediate. I mean, what's your sense as to what's going on here? Do you think that, yes, there's the possibility of economic slowdown, generically speaking, and yes, the dollar has been catching a bid and it's going up, and therefore they would put some pressure on even precious metals, but oil and other commodities too. But all of that put to the side, do you think that there's also a high probability of big money putting in more and more incremental hedges on the fear that a possibility of a deflationary burst could come through?
Yeah, I think so, and I think that deflation, honestly, is a very, very big threat. I mean, deflation would be good for people who kept their balance sheets clean and would find their dollar gaining purchasing power. People that aren't, in fact, I think inflation or hyperinflation is the most egregious outcome, and because it destroys everybody, good people and bad people alike. People that were responsible and people that were irresponsible all get destroyed in a hyperinflation. At least in a deflation, the people that behaved themselves and kept their balance sheets clean will actually be rewarded for it. That said, though, it would be a very, very nasty scenario, and I honestly believe, clearly, if the central banks stood aside and stopped pumping money in the system, we would have the greatest deflation that I think far greater than anything we had in the 1930s. It would be so devastating. I mean, we saw the start of it in 2008, 2009. They managed to catch that falling knife before it fell all the way to the floor, but it was really scary. And I'm not sure they can do it the next time. Who's going to bail out the nations? That's what we're looking at now. I mean, the big corporations and the banks were bailed out the last time. Now you've got sovereign problems everywhere. And so, but the natural inclination would be a devastating deflation. I mean, think about the trillions of dollars that were created, and they're not able to get economic growth around the globe at all to speak of. I would argue that we have negative growth in the United States. We've never really come out of the recession. Even if you take Rick Rule's assumption that inflation is 5% and not John Williams' assumption that it's 8 or 9, his work suggests 8 or 9% rather than the government's sub 2%. So if we have an 8 or 9% or even a 5% inflation rate, and you factor that into GDP, we've not come out of this thing at all. And you have, I think, when you start to look at the labor markets and you start to realize that the number of employed people continue to decrease, something doesn't add up. And there's been a lot of artificial stimulus, not only here but in China to a very great extent. That's a command economy still. They like to talk about China being a capitalist country, but it's not really. It's more of a crony capitalist society than anything, I would suggest. And so you have a tremendous demand for these products, these commodities, and now it's slouching off. So I think. No, I think that a lot of smart money is looking very seriously at deflation. Yeah, I mean, I think that you see it, and the rush to safety is in the U.S. Treasury markets and to a certain extent gold, although I think that's discouraged by the manipulation of the financial markets and the heavy selling to drive the price of gold down. Clearly in the interest of Wall Street to keep people disinterested in gold so they can continue selling their paper products. So I don't think there has to be any grand conspiracy. I think it's just people acting in their own interest as they see it to perpetuate their own confiscation efforts, which is really all we have. The fiat money allows people who control the system to steal from those who create the wealth, and that's why nothing's going to change until the system breaks down, I believe. But yeah, I think I have something called my inflation-deflation watch, which is, if you really talk about when I mention inflation, what I think, and I'm talking not as an Austrian now so much as just a person who has to put food on the table, and when you see the prices rising, prices have been going up a lot more than they're letting on. That's what I'm saying. And of course, the big price rises in the equity markets and in the bond markets has got to be the bubble of all. And the problem, of course, is if that bond market were to burst, then I think you'd have a sudden deflation. You'd have the financial markets deflating, and with that would come also a deflation of the things that Main Street buys, food and oil and that sort of energy products and so forth.
I wish that Ron Paul was still in Congress because he could ask the chair of the Fed, gee, could you explain why bond yields on a 10-year are dropping consistently while you're saying that the economy is so strong?
Yes.
Hello?
Yeah, exactly.
Yeah. All right. As far as, a large number of people within the precious metals community, the Austrian school, et cetera, believe that inflation is the long-run outcome because of the fact that the central banks can, at the stroke of a keyboard, create infinite credit. Bernanke famously boasted that he could, address a deflationary crash within a matter of minutes. I forget what he said, 15 seconds or 15 minutes, but that was a famous quote. And to some extent that's true, and we want to reiterate to our listening audience that, for the most part, certainly speaking for myself, I think that inflation is probably the long-run end game because of this fact. But the point is that in the near term we could have something along the lines of what happened in Cyprus, but not just localized with $10 billion in the financial system of Cyprus, but larger. And it seems like the distortions and malinvestments that have been going on throughout this reboot of the economic system since 2008 have begun to create strains in the credit system that way above beyond what we can see even in examples like Portugal. And that's what concerns me when I see things like oil diving or the 10-year plummeting to new lows for this year. I mean, we were at 3.03, if memory serves correctly, on the yield for the 10-year closing out last year, and now we've dropped 70 basis points plus on an intraday basis. That's just amazing.
Yeah, I agree with that. I think that we could have a major deflationary episode before things fall apart. I mean, clearly the financial system is at risk, and it's all about confidence. And when there's loss of confidence in the dollar, right now people are confident in the dollar, so they go to treasuries as a safe haven. And so far they don't go to gold because they're discouraged from doing so. But if that loss of confidence takes place in the dollar, and this is John Williams' argument for hyperinflation, you can't make the case for hyperinflation because of an overheated economy by any means. But if the dollar were to go to zero, then what are you going to, what's your dollar going to buy? That's the point.
Or just, loss of confidence that reduces its perceived value greatly. I mean, going to zero any short period of time is probably impossible, but the destruction of a fiat currency, which has happened to every single fiat currency throughout entire human history, it will happen over time, and that's really the fear. And then the amount of dollars that are floating around in the international economy is in excess of $10 trillion. So there's a lot of dollars out there, and if people who are holding them, if countries and sovereign wealth funds, et cetera, that are holding them lose faith in the confidence of the dollar, then a lot of those dollars will flow back home, and poof, that's the John Williams scenario of incipient to outright hyperinflation.
Yeah, that would be a hellish scenario. We can hope and pray that never happens.
Yeah, and he's still calling for that for 2005, if I'm not mistaken.
Yeah, he is. He is. I think later this year, even I think he's calling for it. So yeah, the start of it. One thing we know that when economies hyperinflate, it's not a gradual process. It's a hockey stick.
Yeah, right. It happens first slowly, and then all of a sudden.
Yeah, and then all of a sudden it explodes, and it's and of course, with that will come all kinds of other problems. It's not only the inability to put food on your table. We hope that we can sell our gold and silver coins enough to do that, but as society is disrupted to such a great extent, nobody wins from that scenario. And I like to tell my listeners, my radio listeners, and my subscribers that I'm a gold bug not because I want all these horrible things to happen so I can get rich. Quite the contrary. It's that I believe that the table's been set by a disrespect for free markets, and most important free market of all. The most important market of all is the market for money, because half of every transaction involves a currency. So if that currency is illegitimate, then essentially your whole economy becomes illegitimate to a great extent, or it starts to become more and more with malinvestment, financial repression. And so what we want to do is protect ourselves with gold and silver and some of the other assets. And I think, again, you have to start with gold and silver bullion in your possession. That's the bedrock foundation that everybody should start with.
And I just want to throw in here that deflating a currency really does go hand in hand with hyperinflation. Nearly all of the world's hyperinflation events, there's been a period of deflation preceding that. And the reason is it is as you've been discussing, Jay, it is a confidence event. That happens all at once. People lose confidence in the currency and they panic out of it. So it's not that inflation is running at 6% and then 7% and oh boy, we're at 200% next month. It's a confidence event where the people lose confidence in the value of the currency, and it does often happen or nearly always happen in the midst of a deteriorating economy. It's not an overheated. It's not an overheated economy. It's not a monetary event. It's a confidence event.
Absolutely, I agree with that.
We want to give our listeners a quick update here on the physical markets here in the U.S. for gold and silver. Premiums continue to even tighten up a little bit more as coins continue to be available. Pretty much all coins, bars, and rounds are available still for immediate delivery from the U.S. Mint to the Canadian Mint to private bars and rounds. And 90%, which is often the big indicator, the premiums continue to creep down in that as well. So we are seeing a steady purchases, at least at SD Bullion, and talking with a lot of the wholesalers and primary dealers. Overall, the market is off from what it was earlier this year and in 2013, and premiums substantiate that as the 90% premiums continue to fall a bit, which is one of the main indicators of tightness in the market. And so we're not seeing a real tight market right now. So as I've maintained for the last couple of months, as a stacker or investor in physical precious metals, now is a great time where the metals are near their lows and you're not paying substantial premiums for the physical metal due to a market tightness. So I continue to believe it's an excellent time to continue to accumulate your physical precious metals position. And if you already have that, then like Jay said, going forward, a lot of the junior miners with excellent management have bright sunny skies ahead, we believe.
Absolutely do believe that's the case. And yeah, there's a lot of them, and I'm very excited about it. The problem is I don't have enough hours in the day to analyze them, as many as I'd like. Not just to add them all to my list, by the way. There's a lot of these stocks I don't want to have any part of. The vast majority of them, that's the case. But that said, there's really a lot of great opportunities out there, and I think also your point is well taken. That it's a good time to people have seen this equity market and it make new highs, and so little by little people peel off. People might be inclined to buy gold. When I started my radio show, and it was in March of 2009, at the bottom of the post-Lehman Brothers crisis, and there were lots of willing listeners, and the radio show numbers skyrocketed. It went up and up and up, and I was dumbfounded. I couldn't believe it. But now they've tailed off because people aren't interested, and they're saying, oh, well, what do these crazy Austrian guys think? No, anyway. But there was a reception to ideas outside of the mainstream, and I suspect that's part of the reason you're seeing some softness in the bullion markets now. People are actually starting to be conned back into the great Venus flytrap, I suppose you could call the Federal Reserve.
Yeah. Since you mentioned the radio show, we should also tell our listeners that we're picking that up and syndicating it on the News Doctors to help people remember to tune in each week. And one of the things that Jay does that I particularly value, above and beyond the coverage that he does with the precious metal space, and he interviews some of the best people in the world, by the way, but he also does interviews on a weekly basis with people like Daniel McAdams over at the new Ron Paul Institute that focuses a lot on geopolitics and perspectives that people who understand the frame of reference that Ron Paul comes from will definitely appreciate. And the insights that Daniel provides are wonderful. We also carry pretty much all of the articles that Daniel bird dogs on a daily basis over on the Ron Paul Institute website. So kudos for the efforts that you're doing in radio to educate people, Jay. It's fantastic to tune into the program, and we encourage everybody that hears our show today to check it out over the weekend. We'll put a link to that in our write-up as well for this show.
No, thank you very much. Yeah. Daniel McAdams was Ron Paul's, he was his geopolitical guy when he was a congressman, and I know that he is, Ron Paul, I saw just put something out the other day. It's his birthday, and I'm guessing it might be his 80th birthday, because I know he's 13 years older than I am. And he's saying, don't send me a birthday present, except this time you can. You can send a donation to the Ron Paul Institute for Peace and Prosperity, because I know Daniel personally, and he works extremely hard, and they are running that thing on a shoestring budget right now. But if you really want to know what's going on geopolitically, what the United States is doing as opposed to what you're told is being done on the mainstream media, if you want an alternative view of the world, boy, you'll sure get one there. And it is shocking. It is absolutely shocking I believe that what we are being given geopolitically is just as alien to the truth as is what we're given every day in the financial markets.
Yeah, there's a bull market in propaganda.
Absolutely. It's a bull market in propaganda.
Yeah.
Well said.
All right, well, that'll be a good place to close here this week in the bull market and propaganda. Couldn't agree more. Jay, once again, it's great to have you on the show. Thanks for joining us today.
Oh, thank you for having me. It's a pleasure talking with you guys.
For Jay Taylor of miningstocks.com and Eric Dubin, this is The Doc. Thanks for tuning in to this week's SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.